You are a typical investor holding on to a portfolio of companies. It's 2:30 p.m. in the afternoon during market trading hours. Everything seems peaceful. Suddenly, you receive news that one of the factories of the company you own exploded. The share price instantly crashed 20% down. Big problem. What should you do? In this video, I'll advise on what to do, how to prepare for such a scenario. Coming right up. Trying to trade the news. We all know news will affect share price. When it's a positive news, the share price will go up. When the news is negative, the share price will go down. It seems like an easy way to invest. The problem is that watching news is a huge distraction to investors. News moves so quickly these days, more often than not. By the time news reaches an investor, the stock price has moved before they can even react. News network like Bloomberg and CNBC always boast about how fast their information is and how useful they are to an investor. For an investor, unless they can privately release the news way ahead of time and allow investors to take action, the information they provide does not add any value at all. It only serves to distract the investor. The only way you can get news ahead of everyone else is that if you are working within the company or you are working with a company and dealing with their affairs. And even if you are usually bound by non-disclosure agreements and other insider trading rules. Bottom line is that my advice for investors is to disregard news after you are vested, because by the time it reaches you, the price has already moved. It's already too late. There is nothing you can do about it. So if a factory explodes in one of the company you own, do not panic because there is nothing you can do. Instead, continue watching this video to find out what you could have done. Not diversifying. There is really a lot of debate over why we should or should not diversify our portfolio. On one hand, people are saying diversification is for idiot investors who do not know what they are doing. On the other hand, others are saying that you should diversify and spread your risk over many companies. Remember the story I told you about the exploding factory in the beginning? Who would have known, right? If you had diversified into 20 different companies, a 20% price crash on one company will only affect your portfolio by a measly 1%. It won't affect you much. The moral of the story is that you should diversify. You should have a variety of different types of companies in your portfolio. If you have all your funds in only 2 stocks, and if one of those stocks turn bad, you can lose half your fortune. This is really dangerous. Therefore, split your funds into at least 5 different companies. If you can, split it into 20 companies. Nobody will know what will happen to your companies in the future. But in general, the fortunes of a basket of different companies is more predictable than a single company. You always have to be prepared for the unknown. Not going long term. If you are trying to get rich quick, you got the wrong mindset. If you are trying to make money on something right away, you got the wrong idea. Investing does not make you wealthy overnight. In fact, if you are thinking investing is going to give you a big hit on something overnight, it's very unreliable. Successful investing is about having a long-term strategy. Do not hold a company for even 10 minutes. Unless you are willing to hold it for 10 years. Market volatility is one of the most significant risks for any form of investment. The degree to which prices vary over time is measured by volatility. The larger and more frequent the price fluctuates on an investment, the more volatile it is. Because their prices are volatile, investments with high volatility carry a significant amount of risk. Longer term investments are less volatile than shorter term investment. The longer you invest, the better your chances of surviving a market downturn. Stocks and other assets with higher short-term volatility have better long-term returns. Timing the market is both challenging and dangerous. When the stock market begins to decline, many individuals become panicked. Long-term investing, on the other hand, has traditionally produced positive results. Staying invested in the market over long term has historically paid off. While short-term swings may appear random, in the long run, the stock market tends to reflect the economy's overall development and productivity. Investing in long-term rather than short-term assets can also save you money on capital gain tax. Long-term gains are taxed at a lower rate than your income tax bracket. Short-term profits, on the other hand, are treated as regular income and are taxed accordingly. Long-term investments may also save you money on other expenses, such as transaction charges associated with active trading. The bottom line is that it takes a long-term investment to pay off, so you have to be patient. Not doing research. How do you choose your stocks? What do you read? Many people make the mistake of taking shortcuts by reading hot tips from forums and brokerage reports. Investing can be scary. You want to make sure that you are making the right decision. Investing without doing research is a recipe for disaster. While there are times you can get lucky and make a few quick cash without any research, more often than not, those big gains end up being short-lived and result in bigger losses. At the very minimum, you should study the company's financials. At least take quick glances at the net profit growth. There is a huge psychological advantage for me when I buy a share knowing that the company is growing and the price I pay is worth every penny. Even if the share price falls after I buy, I can be confident that this is only temporary because I know the prices are backed by real earnings and the stock price will almost surely recover over time. Some may take shortcuts and trust their fund managers to do the research on their behalf. The problem is that nobody is more concerned with your money than yourself. I have no doubts that these fund managers are capable stock pickers. However, you can get much higher rates of returns when you run your own small fund. The reason is because fund managers running big funds is like steering a big ship. When the market changes, they take very long to turn the ship around, whereby you are riding a speedboat. When the market changes, you are able to change your direction instantly. Investing can be a scary venture because you want to make sure that your money is growing somewhere where it will grow. When picking stocks, always take time to conduct your own research and form your own view. This should help provide some assurance that the company is not only sustainable, but has potential for continued growth. Do not blindly rely on others because everyone has their own personal agenda. Nobody is more concerned about your money than yourself. Do you agree or disagree with the video? Subscribe, leave a like and comment down below, and I'll see you in the next video.